Okay, so the next question that we are going to do is that we are going to attempt this question, which is June 2007. Question number 1. The name of the question is Christos Company. So it's June 2017. Question number 1. The name of the question is Christos Company. Now, let's actually talk about the requirements of this question. That what exactly is this question all about? As I did mention that we are going to be attempting all of those questions, which initially we are going to be attempting the restructuring area. So the question is, it says 8-member board of executive directors of Chrysos, a large private unlisted company, is considering the company's long-term business and financial future. BOD is considering whether or not to undertake a restructuring program. So what are they considering? They're considering whether or not to undertake a restructuring program. This will be followed by a few years later by undertaking a reverse takeover to obtain a listing on the stock exchange in order to raise new finance. So what is actually going to happen is this would actually be followed by, what is it going to be followed by? It is going to be followed by a reverse takeover. Reverse takeover to obtain a listing on the stock exchange. Now what else is going to be there? It says that a few members of the BOD have raised doubts about the restructuring program and the reverse takeover, not least the impact upon the company's stakeholders. Some directors are of the opinion that the IPO would be a better option. The IPO, the initial public offering, would be a better option when obtaining a listing compared to the reverse takeover. Now, so this is what it is. Now, basically what is happening with this company is the company's directors are planning to undertake a restructuring program. Then they would actually go for a reverse takeover, and then they would obtain a listing on the exchange in order to obtain new finance. And some of the directors are suggesting that in order to obtain finance, it's better that we go for the IPO rather than reverse takeover. Now, let's talk about the requirements of this question, that what exactly are the requirements to this question. The requirements to this question is, it says explain what a reverse takeover involves. It says explain what a reverse takeover involves and discuss the relative advantages and disadvantages to a company such as Chrysos Company of obtaining a listing through a reverse takeover as compared to an IPO. So what is it? We need to explain that what exactly is a reverse takeover. Now, so that's one of the requirements. Now the next requirement is, it says prepare a report for the board of directors of Chrysos Company, which includes an extract of the financial position and an estimate of Chrysos value to equity holders after undertaking the restructuring program. So what do we need to do? We need to actually we need to prepare an extract of the balance sheet, and we need to estimate the value to equity holders after undertaking the restructuring program. What else is there? It says an explanation of the approach taken. We need to explain the approach that is taken and the assumptions that we have made. The approach taken and the assumptions that we have made in estimating the Chrysos value to the equity holders after undertaking the restructuring program, and a discussion of the impact of the restructuring on the venture capital organization. So what is going to be the impact on the venture capital organization? That is something we need to talk about. So this question is almost similar to the last question that we attempted, but it says that this question has got additional computational elements, and those computational elements are then going to be mixed up with this. Lastly, it says discuss why the attention Chrysos Company pays to its stakeholders represented on the supervisory board may change once it has obtained listing. So basically we need to talk about the supervisory board, which is the second board which actually comes into play when you have got a listed company in place. So that's what you have to talk about. Now, what I'm actually going to do is that I'm going to talk about part A to the question first, and then I would give you time to attempt part B, right? Now, if I talk about part A of the question, that what a reverse takeover involves. Now, what is a reverse takeover? If I talk about the concept of reverse takeover or the reverse acquisition. So basically what happens is reverse acquisition is actually a process whereby what happens is, this is a company, this is a listed company. Now what happens is, this is a company and this is a listed company. Now under the reverse takeover, what actually happens is that this company tries to acquire this company. This company tries to acquire the listed company. And during the process of acquisition, what it does is that the consideration it pays is in the form of shares. So like for example, what would happen is this company may have got total 100 million shares and this company may have got, let's say, 50 million shares. So you have a company which wants to acquire a listed company. Now, how are things gonna operate? So the reverse takeover happens this way, that you will acquire this listed company's entire 50 million share capital, and the consideration that you would actually do is that the consideration is actually going to be in the form of the entity's shares. So we would actually issue as many shares to this listed company such that this listed company ultimately ends up acquiring us. So what is a reverse takeover? You actually go for acquiring a company and in the process you get yourself acquired. So it's actually a process where you actually go and try and acquire a company and in fact you actually get yourself acquired. Okay. So now what actually happens is, so the reverse acquisition is actually one of the ways that usually the private companies they use. The private companies they use because what happens is that the private companies they acquire listed companies and in the end they themselves get acquired. So as a result of this, the shareholders of the company become the owner of this company. The shareholders of the company become the owner of this company. Now, this reverse acquisition is a method of getting listed and it's an alternate to IPO. It's an alternate to IPO. What is IPO? The IPO is the initial public offering. It is alternate to IPO. What is IPO? IPO is initial public offering. Now, so basically what are the advantages and what are the disadvantages of reverse takeover as compared to IPO? So what I'm actually going to do is that I'm going to talk about the IPO disadvantage and IPO advantage. If I'm going to talk about the IPO advantage, then this IPO advantage would become the disadvantage of reverse takeover. And if I'm going to talk about the IPO disadvantage, this will become the advantage of reverse takeover. So first of all, IPO is expensive. IPO is expensive. Why? Because when you go for IPO, you've got a lot of things that you need to do. You need to market your company. You need to go through the credit rating agencies. A lot of things that you actually need to do. Number two is that it's a time-taking process also. It's a time-taking process also when you go for this. And at the same time, during the economic downturn, what happens is that the IPO may fail. IPO may fail. So when you actually go for the IPO, if it ends up failing, then you will have to sell the shares of the company to the underwriters. And the underwriters are going to buy the company share at a substantially lower cost. So what is actually suggested? So the suggested situation is that what we should do is that we should actually go for the reverse takeover during the case of the economic downturn, because what would happen is the reverse takeover would lead to guaranteed listing, but IPO would not lead to guaranteed listing. What is the reason behind that? Is when you actually go for IPO, if the shares are actually not sold in the market, then you will have to appoint an underwriter in order to sell those shares, and the underwriter are going to buy those shares at a substantially low cost. Now, the second thing is that what exactly are the advantages of this IPO? So basically what happens is the reverse takeover may not reflect actual price of acquiring. That's number one. The number two is that acquiring may have hidden liabilities, etc. Investor access may not be achieved as IPO creates interest amongst analysts, etc. Whereas RTO does not. So when we talk about the reverse takeover does not create that much hype of the company. If the company goes for the IPO, IPO creates a hype. So what happens is you need to understand this thing. The examiner asked for the reverse takeover, so we talked about that reverse takeover involves that when you have a company which wants to become a listed company, so what it does is that it acquires a listed company, and in the end it itself gets acquired. So resultingly it gets listed. Basically the advantage of going for the reverse takeover is less expensive, reverse takeover is less time taking, and at the same time it's a guaranteed listing, especially in times of economic downturn. But when it comes to the disadvantage of reverse takeover, so what happens is that the company whom you are acquiring may have got hidden liabilities, so you may not know about them. You may not be able to get the exact price of the acquiry. You may end up paying an extra price, a higher price. And in the end, one more important thing is that we need access to finance. We need access to investors. The main reason for listing is to get access to investors. Now, investors' access is largely dependent upon the analyst talking about the company. So when you do IPO, the advantage of IPO is that a lot of analysts actually end up talking about the company. But when you go for the reverse takeover, not many analysts would end up talking about the company. So these are the few things that happens when we talk about the reverse takeover and the initial public offering. Now, what I would actually want you people to do is that to attempt the part B of the question now. And the part B of the question is where you have to actually prepare a report for the board of directors, which includes an extract of the financial position and estimate of Chrysos value to equity holders after undertaking the restructuring program. So let's take 5-7 minutes, go through this part B of the question and try to attempt it. So you need to take this time till 5:35 p.m. to try and achieve something out of this question. Okay, so now let's talk about this question. It says Chrysos was formed about 15 years ago. It says Chrysos was formed about 15 years ago by a team of 5 senior equity holders who are part of the BOD and own 40% of the equity share capital in total. There are 30 other equity holders who own for the further 40% of the equity share capital, but are not part of the BOD. So this is a similar type of scenario where you've got 5 people who own 40%, you've got other 30 people who own 40%, and you have got venture capital organization which is actually owning 20% and have 3 representatives on the BOD. So these are 5 people and these are 3 people. So this makes it 8 people. The VCOs have also lent Chrysos substantial debt finance in the form of unsecured bond due to be redeemed in 10 years' time. In addition to the BOD, Chrysos company also has non-executive supervisory board consisting of members of Chrysos company's key stakeholders group. Details of the supervisory board are given below. Now it says the company has 2 business units, a mining unit and a shipping business unit. So what exactly do we have? We have this Chrysos company having one of the mining sector and the other one of them is the shipping business. And mining and shipping business unit and a machinery parts manufacturing business unit. In fact, mining and shipping is one single business unit that they have. Then there is this machine parts business manufacturing. It says mining and the shipping business accounts for around 80% of the Chrysos business in terms of sales, non-current assets, current assets, and payables. So it's actually 80% of the total business. That means this is 20%. However, it is estimated that the business unit accounts for around 75% of company's operating costs. The operating costs are 75% pertaining to this. The smaller machinery parts manufacturing business accounts for remaining 20% of sale revenue and around 25% of the company's operating costs. It says the following figures have been extracted from the Chrysos, the most recent financial statements. So we have been given sale revenue, operating cost, PB, IT, etc., the non-current assets, secured bonds, etc., etc. So what exactly do they own? They own non-current assets, current assets, and payables. It says corporate restructuring program. The purpose of the restructuring program is to simplify companies' gearing ratio and to obtain extra funding. So what are the objectives? One of the objectives is to simplify the gearing structure. The second one of them is to obtain extra funding to expand the mining and the shipping business in the future. At present, Chrysos is having difficulty obtaining additional funding without having to pay high interest rate. That means the interest rate will be high. The interest rate will be high. Now, it says machinery parts manufacturing business unit. The smaller parts will be unbundled. Unbundled, what exactly do you mean by unbundling? Means actually it's going to be divested, or it's going to maybe made into a separate company, or etc. something. Either by having its assets sold to a local supplier for $3102 million after its share of payables have been paid. So once the payables have been paid, they would sell it for $3102 million. Now what else is there? So after its share of payables have been paid, it is going to be sold. Its assets are going to be sold for $3102 million. Now what next is there? The smaller parts business unit will be unbundled, or the what else is there? It will be unbundled through a management buyout by 4 managers. In case it is estimated that after tax cash flows will increase by 8% in first year only, and then stay fixed at this level for the foreseeable future. The cost of capital related to smaller business unit is estimated to be 10%. Management buyout will pay 70% of the estimated market value of the smaller machinery parts business unit. So what happens is the MBO team will pay Chrysos company 70% of the value. So what is it actually going to pay? It is actually going to pay you 70% of the value. Now what happens? Following the unbundling the smaller machinery parts manufacturing business unit, Chrysos will focus solely on the mining and shipping business prior to undertaking the reverse takeover some years into the future. So what is actually going to happen? Chrysos company is actually wanting to strategize its business units, and it wants to align its business unit with the corporate strategy. So that's why what it is actually doing is that it is actually undertaking these activities of basically unbundling the manufacturing unit and then actually focusing solely on the mining and the shipping business unit. Now what next is going to happen? It says, as part of the restructuring program, the existing unsecured bonds lent by VCOs will be cancelled and replaced by additional $600 million $1 shares. VCO will pay $400 million for these shares. The bank overdraft will be converted into a 15-year loan on which Chrysos will pay a fixed interest of so and so. The other debt and the current liability will be repaid so and so, so and so. It says, so basically it's going to be a restructuring activity that's going to take place. The third one of them is, it says additional financial information. Chrysos aims to maintain a long-term capital structure of 20% debt and 80% equity in market value terms. So basically what is going to happen is debt upon debt plus equity is going to be 20%. Chrysos finance director has assessed that 4.5 annual interest it will pay on its bank loan is reasonable estimate of its long-term cost of debt. So basically the KD is 4.5%. What else is there? It says that based on the long-term capital structure above, although Chrysos does not know what its cost of capital is for the mining and shipping business, its finance data has determined that the current ungeared cost of equity of Sidr company. So the ungeared cost of equity. So cost of equity ungeared is basically 12.46%. Now what else is there? It says Chrysos finance data wants to use Sidr company's ungeared cost of equity to calculate its cost of capital for the mining and the shipping business unit. The annual corporation tax on profits applicable to all companies is 18%, and it can be assumed that the tax is payable in the year incurred. Furthermore, we are being told all non-current assets are eligible for tax allowable depreciation of 12%. And what else are we being told? We're being told annually on the book values. And the annual reinvestment mandate to keep operations is equivalent to the tax allowable depreciation. Now, details of the supervisory board, etc., we need to actually skip it right now. Now, what exactly is the requirement? It says an extract of the financial position and an estimate of the Chrysos value to equity holders after undertaking the restructuring program. So what do we need to do? We need to calculate after undertaking the restructuring program. Now, how exactly are things going to operate? That's what we need to talk about. Okay, now what next is going to happen? So what we need to do is that we need to perform the calculations and we need to see that how are things actually going to operate in this scenario. Okay, see, first of all, what is actually going to happen? We are going to say that what if the option number one, because what happens is the restructuring options are like this. Option number one is basically you sell this, you sell the assets of this division. Sell the assets of this division. Now, when you are actually going to sell the assets of this division, so what is the price at which we can actually sell the assets of the division? So what is the price that we are being told? It's basically on the page 2 of the question. We are being told that we are going to get 3102 million. We're going to get 3102 million. So the restructuring options that we have is one of them is either we sell it to the local supplier for 3102 million. Okay, you come to this part of the question. So you are being told that the machinery parts manufacturing business unit. What is actually going to happen with this business unit? You can either sell it for 3102 million or you can go for the management buyout. Okay, the second situation is the other case is that it could actually be unbundled through a management buyout. Now, when it is going to be unbundled through management buyout by 4 managers, what is actually going to happen? That's what we need to actually see. So it says that it's estimated that its after-tax net cash flow will increase by 8%. Its after-tax net cash flow will increase by 8% in the first year only, and then stay fixed at this level. The cost of capital related to the smaller business unit is estimated to be 10%, and the management team will pay Chrysos 70% of the estimated market value of a smaller machinery unit. So what is going to happen? What we are actually going to do is that we're going to say that if we talk about option number 2, if we talk about option number 2, so what is going to happen? What is going to happen is we need to actually value this business, and we need to value this business using the free cash flows to firm methodology. Now, how exactly are we going to do it? So let's talk. So the sales, which is actually around 20%, the sales which is 16,800 multiplied by 20%, that's what the sale of this segment is. This sale is the sale of this segment is 16,800 into 20%. So what exactly is it going to be? It's going to be 16,800 into 20%. We get 3360. What do we get? We get 3360. Now, the operating cost that we are actually going to have is the current operating costs are 10,080, and this segment has got 25% of the operating cost. That's what we are being told originally. So if it is 10,080 and it's going to be multiplied with the 25%, that means 2520. 2520. So we have got 2520 and 3360. Resultingly, we have got 840 as the PBIT. What do we have? We've got PBIT, which is actually 840. Okay. So the next situation is basically the depreciation that we are going to calculate. Now, what exactly is going to be the depreciation that we are going to calculate? The entity has total 7,500 plus 5,400. These are the land and building plus the equipment. Of this, 20% belongs to this segment and it is expected to be depreciated by 12%. So what is going to happen? 7,500 plus you have 5,400. So this makes it 12,900 in total. Multiply by 20% and multiply by 12%. Multiply by 20% and multiply by 12%. This gives us 309.6. This gives us 309.6. So what would happen is the profit before the tax is going to be, what is it going to be? 530.4. So if it is going to be 530.4, what is going to happen? We're going to charge tax at the rate of, we are being told that the entity pays tax at the rate of 18%. Where is it mentioned? In the additional information section. You go to the additional information section, you're being told that the entity pays tax at the rate of 18%. So if the entity pays tax at the rate of 18%, then what is going to happen? So you'll have 530.4 multiply by, in fact 530.4. It's going to be multiplied with 0.18. So it's 95.472. 95.472. Resultingly, we are going to be left with free cash flows to firm. And how much that free cash flows to firm is going to be? It's going to be 530.4 minus 95.72. Resulting is 434.93. 434.93. Now, if we have got free cash flows to firm of 434.93, then what else is going to happen? So when we are going to calculate the value of this business, the value of the business is present value of the future cash flows. Value of the business is present value of the future cash flows. So these 434.93 are expected to grow by 8%. That means it's going to be 1.08. So it's expected to grow by 1.08 and the cash flows are going to arise up till infinity. The relevant discount rate that we are being told is actually 10%. So resultingly 434.93 multiply 1.08 divided by 10%. No, the depreciation isn't included in the operating cost. The depreciation is separately being charged. 10% is a discount factor. You see, the information I've actually used, the information that I've actually used is here. So what we get is 4697 is the value of this entity, and we are being told that Christos would get 70% out of it. Christos will get 70% out of it. So if I calculate 70% out of it, it becomes 3288. What does it become? It becomes 3288. It becomes 3288. Indefinite. for the indefinite period. You see here. Now, what I've actually done is I've actually applied this part. I've actually handled this part up till now only, which is this is what we were being told. See. So this is actually number one, which is to sell off. Number two is the free cash flows to firm. This is how I've calculated it. Okay, I hope everybody is okay with it. Abdul Qayyum, the depreciation you see here, look at the profit and loss account that's been given in the question. You're being told it's profit before depreciation, interest, and tax. That means there is no depreciation, no interest, no tax incorporated in the operating cost. Okay, so what have we done right now? We were actually required that extract of a statement of financial position and the value to the equity holders after undertaking the restructuring. Now, what is it actually going to happen? Up till now, we have actually unbundled the machinery and the parts manufacturing business unit. And the two options that we have right now, the two options that we have is 4697 into 70%. So the two options that we have is either we sell the assets for 3102 million, or we actually sell the business through management buyout and we end up getting 3288. So since we are getting a higher value, what is happening is we are getting a higher value. A higher value is available in management buyout. Therefore, it is assumed that MBO is pursued. So what happens is the management buyout is pursued. Why? Because you are getting a higher value in MBO. Okay, so now let's move forward. Now, what else needs to be done in this question? Let's talk. We are being told mining and shipping business units. It says following unbundling of the smaller machinery parts, Chrysos will focus on the mining and shipping business. Now, what happens is as part of restructuring program, these are the changes that are actually going to happen. What is going to happen? The existing unsecured bonds lent will be cancelled and replaced by an additional 600 million $1 shares. The VCO will pay 400 million for these shares. The bank overdraft will be converted into 15-year loan, and the entity will pay a fixed annual interest rate of 4.5%. The other debt under the non-current liabilities will be repaid. Other debt under the non-current liabilities will be repaid. In addition to this, Chrysos will invest 1,200 million into equipment for its mining and shipping business unit, and this will result in its profits and cash flows growing by 4% per year in perpetuity. So now what you need to do is that you need to now calculate, because the question's requirement was following the restructuring plan, you need to calculate the value of the business, you need to draw the balance sheet. Now, if I need to calculate the value of the business following the restructuring plan, so I need to understand that what is going to happen. First of all, what I am going to do is that I'm going to calculate the free cash flows to firm of this business. And when I'm going to calculate the free cash flows to firm of this business, so these free cash flows to firm would actually be discounted using the discount rate. And after the discount rate is being ascertained, so what we are actually going to do is that okay, once we have the discount rate, so what we need to do is that we need to actually what we need to do is that we need to actually discount them using the relevant discount rate. Now, so there are two things, there are two question marks, that how exactly are we going to calculate the free cash flows to firm, what exactly is going to happen, that's what we need to calculate. Now see, please you are requested to stop the video. In case if you do join, please join without video. Okay. So if I have to calculate the value of the business, which is post unbundling, if I have to calculate the value of the business post unbundling, let's actually talk about it. The first thing that we are actually going to do is that we're going to say that there is going to be a sale. How much is the sale going to be? The sale is going to be 16,800 multiplied by 80%. So it is going to be 16,800 multiplied by 80%. What is 16,800? 16,800 is actually the total sale of the business, and the 80% belongs to the mining and the shipping business. The operating cost of the mining and the shipping business out of this 10,080 is 75%. So when we talk about the operating cost, so what are we going to get? 10,080, and it's going to be multiplied with 75%. So it is going to be 7560. What is it going to be? 7560. So what is going to happen is minus 13440 is going to be 5,880. 5,880, this is profit before interest, tax and depreciation allowance. So profit before interest, tax and the depreciation allowance. Now, what we need to do is that we need to calculate the depreciation. We need to calculate the depreciation. Now, how exactly are we going to calculate the depreciation? So it's actually the depreciation post unbundling. Now you need to understand one thing. What is it that you need to understand is actually that you have divested around 20% of the business. That means 20% of the assets have actually gone out. The 20% of the assets have actually been disposed of. Unbundling is basically splitting the organization. Just like what you have done is you had a single entity which had two parts. So what you have done is you have actually specifically separated one part from the whole entity. That's unbundling. That's splitting the organization. Dividing into multiple, two or multiple. And two or multiple segments of businesses. What have they done is they have actually converted into separate entity and they've sold it out. Unbundling. Okay, so now we need to calculate the depreciation, and how exactly are we going to calculate the depreciation? So the depreciation is going to be 12% of the assets of this segment. Now, how exactly are we going to get the assets of this segment? That is something that needs to be established. First of all, you need to understand that the total assets of the business were land and building and the equipment. The land and building was 7,500 and the equipment was 5,400. So when we talk about is 7,500 and 5,400, so what are we going to get? 7,500 and 5,400. This is what we have, 12,900. Of this 12,900, we are now left with 80%. Why? Because we have actually disposed of some part of the business. So we are left with 10,320. And we invest 1,200 more into the new equipment. The new equipment are actually going to be 1,200 that we will invest. This is mentioned in this second page, third paragraph under the mining and the shipping business unit heading. So what are we going to get? You're going to get it like this. Plus 1,200. So this makes it 11,520. Now, if this makes it 11,520, then what is going to happen now? So what are we going to do is that we're going to say 12% into 11,520 is what we are actually going to get as a depreciation. So if I say 12% into 11,520, so how much are we going to get? We've got 1382.4. 1382.4. So if we say 1382.4 minus 5880 gives us 4497.6. What do we get? 4497.6. Now, if you've got 4497.6, then what is going to happen is we will have to pay a tax at the rate of 18%. So if I deduct 10%, 18% tax, so I end up getting the free cash flows to firm into 0.82, 3688, 3688. So I'm going to stop for a minute in order to reconcile as to whatever that we have done up till now. Well, the payables are already going to be paid out. Sunita, the question says that after settling the payables, this is the amount that you're going to pay. So what have we done up till now? We have actually unbundled this machinery part. And while unbundling the machinery part, one of the option was to sell the assets. So we sold them for 3102, but that didn't yield a greater value. The other option was unbundle it through a management buyout option. We went for the management buyout option. And while we actually used the management buyout option, so what actually happened was we were able to unbundle it at a higher value. So we actually decided to unbundle using the management buyout option. Now, after the unbundling, what has actually happened is we are now left with focusing on the mining and the shipping business unit. So once we are actually being focusing on the mining and shipping business unit, we are being told that the entity has invested 1200 million in this mining and the shipping business. So what I have actually done is I have now calculated the cash flows, the free cash flows of the mining and the shipping business, which is 3688. But the problem that I have is I don't have the discount rate available. The problem that I have is I don't have the discount rate available. So that means I would have to calculate the discount. I don't have the discount rate available. That means I would have to calculate the discount rate. Now, how am I going to calculate the discount rate? So let's come on to the question again and talk about this additional financial information. It says Chrysos aims to maintain long-term capital structure of 20% debt. That means the long-term gearing is going to be 20%. Furthermore, we are actually being told that the entity does not know what its cost of capital is, but it has determined that the current ungeared cost of equity of Sidero company, a large company quoted in mining and shipping, was 12.46%. So the ungeared cost of equity of Sidero company was lower than this, and it says that it wants to use Sidero company's ungeared cost of equity to calculate its cost of capital. You can't actually use Sidero's ungeared cost of equity to calculate your cost of capital. What you'll have to calculate is you'll have to calculate the cost of equity of the geared company using this Sidero company as a proxy company. So what are we going to do? We're going to use MM2. What are we going to do? We're going to use MM2. Now, what is the formula for MM2? What is the formula for MM2? Okay, so if I talk about it, in the exam you are being given the formula for MM2 because you are being given cost of equity of a company, but you are not being given the cost of equity of this company. So we've been given the ungeared cost of equity of the company, but we're not being given this company's cost. So what we are going to do is that we're going to say, let's actually use this formula. What is this formula? This is actually cost of equity of ungeared company is equivalent to cost of equity of an ungeared company is equal, cost of equity of a geared company is the cost of equity of ungeared company plus this whole and whole. So now, what are we gonna do? Now let's talk. We're gonna say the cost of equity is going to be 12.46% plus 1 minus t, 1 minus 0.18, and then you will have it multiplied with what? Multiplied with 12.46%. Multiplied with 12.46% minus 4.5%. Multiply by 0.2 divided by 0.8. So let's calculate the cost of equity using this formula. Okay, can somebody please confirm the value? Can somebody please confirm the value of this whole? 14.09. Okay, 14.1%. Iman, what I am taking is 14.1%. Now, so if I am gonna take 14.1%, now let's talk. Now let's talk about it. If I'm gonna take 14.1%, what exactly is it going to be? Now, basically, now you've got this cost of equity of 14.1%. We need to calculate the cost of capital. So how are we gonna calculate the weighted average cost of capital? We're gonna calculate it this way. 14.1% is our equity. We're going to multiply it with 0.8, the market value of equity, plus KD, which is 4.5%, multiply with 0.82, KD1 minus T, then you multiply it with 0.2. So resultingly, what else, what is the WACC that we end up getting? Okay, because when you've got free cash flows to firm, so you need to use WACC. When you've got free cash flows to equity, you use K. Okay, 12%. Thank you, Farah. So we end up getting 12%. We end up getting 12%. Now, so we've got 12% as the weighted average cost of capital. Now, what else do we need to do? We need to calculate the value of this business. How would we calculate the value of this business? We are being told that the business's cash flows are going to continue to grow by 4% up till infinity. We are being told that the business's cash flows are going to grow by 12% up till infinity. Now, so what are we going to get? We're going to get this way. Three six double eight multiply by 1.04 divided by 12% minus 4%. So how much are we going to get? No, you use geared cost of equity. They have given you ungeared cost of equity of the entity, which is 12.46%. So we use that in order to establish the geared cost of equity. Okay, thank you, Iman. 47,944 is the value of the business. Is the value of firm. 47,944 is the value of the firm. Okay. You go through this question, you'll find that they will keep on growing by 4%. This is where it is mentioned. Okay, so 47,944 is the value of the firm. Now, what are we required to answer? The question actually asks us that what is going to be the value of. The question actually asks us that what is going to be the value to the equity holders. So how would we calculate the value to the equity holders? So we need to remove the value of debt from it. We need to remove the value of debt from it, so we'll end up getting the value for the equity. Now, how exactly are we going to remove the debt from it? So let's actually try to understand. First of all, let's see the company's balance sheet. So when we see the company's balance sheet, what do we have? We have non-current liability of 4,800. We have other debt of 1,050. And we have a bank OD of 1,800. So this is what we have: 4,800, 1,050, and 1,800. So the book values of these debts are what? The book values of these debts are 4,800 plus 1,050 plus 1,800. So resultingly, it's gonna be 7,650 is what we had. Now we need to see that what are we gonna be left with. So we're being told, as part of restructuring program, the venture capital organizations unsecured bonds will be cancelled. So that means 4,800 is gone and replaced by additional 1 million shares. VCOs will pay 400 million for these shares. So the bank OD will be converted to 15-year loan. The bank OD will remain. The other debt under non-current liabilities will be repaid. The other debt will be repaid. So okay, so what are we going to be left with only? We're going to be left with only 1,800 of the bank OD. We're going to be left with 1,800 of the bank OD only. Why? Because the other debts are going to be repaid. So where are we going to stand now? 47,944 minus 1,800 gives us 46,122. Gives us 46,122. Okay, is everyone okay with this? I know this is too much of complicated calculations, but this is how it is. This is how it is. If you come across a restructuring scenario, that is what you need to do. And the part is still not over yet. We need to go through, we need to draft the financial statements also. So we're going to draft the financial statement, but first of all, what I would want is, I want you people to be satisfied and happy with it. Okay. You see the total debts that we have 4,000. You have the balance sheet in front of you. You have the question in front of you where you have got the balance sheet. 4,800 is the loan from venture capital organization. There is other debt also, and there is overdraft also of 1,800. Now, what are we being told? We are being told the venture capital organization. Now, first line it says the existing unsecured bond lent by the venture capital will be cancelled. That means the $4,800 debt is cancelled out. Okay, so that means that's no more there. Now, what's the second one? The second one is, it says that the other debt will be repaid. It says the other debt will be repaid. Now, if the other debt will be repaid, that means that's not going to be there anymore also. And what are we going to be left with? We are going to be left with OD, which is going to be converted into a 15-year loan. The overdraft will be converted into 15-year loan. So we are going to be left with overdraft only. We had three types of debt. Overdraft is converted into long-term loan. One other debt is being repaid, and the venture capital organization debt is cancelled out. So we are left with only $1,800 of debt. Yes. No, what 1,200 plus 600? No, it's just the venture capital organizations that, in fact, the overdraft that is left. That's it. Okay, so 46,144 is the value of equity. I'm saying it again, that we are still left with the balance sheet. Okay, Qayyum, good question. A student is asking a question that why have you not calculated the present value of this debt? Now, why have I not calculated the present value of this debt is because this debt is being converted into a loan as of today. So if it's being converted into a loan as of today, that means its book value and its market value is the same. Because it's immediately after unbundling, it's immediately after this refinancing that we have calculated. So if you issue a debt today, its market value and its book value would be the same probably. Now, what we need to do is that we now need to calculate What we now need to do is that we now need to establish the balance sheet of the entity. So what are we going to do is that we're going to establish the balance sheet of the entity. So in order to establish the balance sheet of the entity, we'll have to perform some working. So I'm actually going to copy this balance sheet, and so that you can have an idea that how do we actually perform this balance sheet, because I did perform this similar type of workings in the previous question also. Okay, now, so if we use this, now let's talk. So how are things actually going to operate? This land and building of 7,500, only 80% of it will be left, which is 6,000. The land and building of 7,500, only 80% of it will be left, which is going to be 6,000. What else is going to be there? The equipment. The equipment are going to be you will dispose of 20% of it. So 80% of it will be left, plus additional investment of 1,200 will be made. So resultingly, what is going to happen is 5,400 into 0.8, and then plus 1,220 minus 1,220 plus 1,200. So it's 5,520. What is it going to be? 5,520. Then we have got the inventory, so we are going to be left with 80%. We are going to be left with 80% of the receivables also. So 1,800 into 0.8 gives you 1,440, and 900 into 0.8 gives you 720. Now, what is going to happen with the cash? So we'll have to perform the reconciliation for the cash also. So we're going to do that also. Just wait for a bit. What is going to happen with the cash? We're going to say that the cash, which is right now 0, we are gonna dispose of that division, which is actually the division that we disposed of was the machine parts division. How much value did we dispose it of? At 3,289. 3,289. Okay, any other movements with the cash? So yes, there is a $1,200 investment in the equipment, and we'll see if there are any other movements also in the cash. We'll have to perform the share capital workings. What is going to happen with the share capital? So let's talk. We are being told under the restructuring scheme that as part of the restructuring program, the existing unsecured bonds lent by VCOs will be cancelled and replaced by additional 600 million shares. So there's going to be a 600 million more shares issued. The VCOs will pay 400 million for these shares. What are they going to pay? They're going to pay 400 million for these shares. So there is actually going to be a cash of 400 million out of it. Now it further says the bank overdraft will be converted into 15-year loan. So we do know that the bank overdraft, this unsecured bond is going to be cancelled out. There is basically 4.5% 15-year loan from the bank, and that is going to be 1,800. We are further being told that the other debt under the non-current liability would be repaid. So minus 1,050. Minus 1,050 from the cash also. So we are actually going to be The payables are going to be left as 600. This 1050 will become 0. This bank OD will become 0. The cash that we will have is 0 plus 0 plus 3289 minus 1200 plus 400 minus 1050. So it's going to be 1439. What is it? 1439. 2400 is going to be your capital, and you would have balancing figure as the results. You'll have balancing figure as the results.
So back because we have minus 479 so 1800 minus so 24 minus 3 plus.
Anyway. How much does it turn out to be? 10339? Is it correct? Can somebody please perform the recalculation of this whole? Yes, 720. Okay, it's actually 15119. It's not 153,139. It's 15119. So it would also change 15319. It would become 15319. Okay.
So the minus plus 479 double four right. Means to get minus 700. To get 1800 minus the table minus
No, it's only the long-term debt that's considered. When you calculate the debt actually means long-term debt. Okay, is it okay with everybody? We have prepared an extract of the financial position. We have discussed that the value to the equity holders after undertaking the restructuring program. Now, it says an explanation of the approach taken and assumptions made in estimating Chrysos company's value to equity holders and undertaking the restructuring program. Okay, so it's more or less a similar type of question that we did previously. These two parts, which is the third part, is also a discussion of the impact of restructuring program on Chrysos and on the venture capital organization. So this is what these part 2 and part 3 are more or less similar to the part that we attempted in the previous question. Okay, do I actually need to go through these parts? Okay. Okay, now let's see. So basically, we are being told that we need to state the assumption. Okay, I'm going through this part because a lot of the students are actually requesting that I should go through these parts. So, but first of all, the first thing that I'm going to do is that I'm going to say that we need to consider the various assumptions that we have taken in the calculations. You see, so the assumptions that we are going to take in this calculation is going to be, first of all, you see, you need to understand that your calculation is dependent on a lot of factors. Your calculation is dependent on a lot of factors. Now, what are those lot of factors that your calculation is dependent upon? So let's actually talk about that a lot of factors are going to be like this. Number one, what have we done? We have calculated the free cash flows to firm of this company. So whatever assumptions that we have used while calculating free cash flows to firm and the assumptions that we have used while recalculating the debt, they need to be actually, we need to state them. Now, what are going to be those assumptions? Let's talk about them. So if I talk about this requirements part B2, I'm going to say the various assumptions that we actually took while we performed this calculation is that the cash flows will grow by 4% in perpetuity. There is no extra working capital needed after investment in equipment. Tax rate and gearing remain unchanged. The PBIT is correctly estimated. PBIT is correctly estimated. And what else was there? The ungeared cost of equity of that proxy company. What was the name of that proxy company? Sidero company. Is a reasonable estimate of ungeared cost of Chrysos. So you see the assumptions that we have actually taken, I mean, they are evident from the calculations that you have performed. The major thing is that you need to say that whatever that we have used, whatever estimation that we have used, whatever that we have actually performed the calculation, it's all going to happen the way we have actually taken it to be. Okay, so the next part, so I hope that this is clear now. And now the last part of the question is, it says a discussion of the impact of the restructuring program on the Chrysos company and on the venture capital organization. So let's actually discuss about it, that what is going to be the impact on the Chrysos company and the venture capital organization. So let's actually discuss. So let's talk about part B3. Now, let's talk about the venture capital organization. They currently had 40% of the entity's shares, or something less than that. Or that. Okay, no, they had 20% shareholding of the entity. They had 20% shareholding of the entity. Yes, you have to state that FCFF is a reasonable estimate of estimating the value of the firm, and that the method that we have used of deducting the value of debt out of it, that is also reasonable. So now, first of all, the impact on the venture capital organization. They currently have 20% shares of the company. Do we have the current value of the company? Okay. If I assume that the debt of the company, which is basically 4800 plus 1050 plus 1800, is 20% of the value of the entity, and the 80% of the value is attributed to equity. So what is going to be the value attributed to equity? 4800 plus 1050 plus 1800. So we have got 7650. If I say this is divided by 0.2, so multiply by 0.8, so 30,600 is the value of the equity. 30,600 is the value of the equity. Now, so if we talk about the value of the equity right now, it's 30,600. What is going to be the impact of this restructuring program on the Chrysos? The value of the Chrysos company has actually become 46,144. Has actually become 46,144 post this restructure. Now you would say, how have I estimated the values? I have actually assumed that the values shown in the balance sheet for the liabilities are almost equal to the market value of those debt instruments. So what I have done, I have actually grossed them up to calculate 80% value. Now if I have grossed them up to calculate 80% value, so it is actually going to be 30,600. Now we compare it with 46. We compare it with what? We compare it with 46,144. That means there is actually an increase in the value of what? There is an increase in the value of this minus 46,144 divided by 30,600. It's approximately 50.8% increase. So now, if we actually discuss the impact of this on the Chrysos company, so it's actually having a favorable impact on the entity. It is having a favorable impact on the entity. There is actually a favorable impact on this entity. Okay, so basically it's having a favorable impact on the entity. Now, what is going to be the position of the virtual capital organization? The virtual capital organization currently has 20% shares in the company, and what are the total number of shares in the company right now? They are 1800. So the number of shares that they have right now out of these 1800 is 360. Is 1800 multiplied by 20%. This gives you 360, which is actually the number of shares owned by the virtual capital organization right now. Now the virtual capital organization is now being entitled to get 600 more shares of the company under the restructuring scheme. We have given them 600 million more shares of the company. So if we have given them 600 more shares of the company, and so that means the number of shares that they would have is now 960. This 960 is now going to be out of what? This 960 is going to be out of what are going to be the total number of shares right now of the company? They're going to be out of 2400. This is out of 2400 shares. Meaning, what has happened is 960 divided by 2400 gives you 40%. Okay. So that means the shareholding of the virtual capital organization has actually doubled up. Now see. So we need to establish that how much gain has actually arisen to them. What has happened is the value of their 360 million shares. The value of the 360 million shares was what? Was 30,600 into 20%. Gives you what? 30,600 into 20%. Gives you 6120. That was their value. Now they have got 960 million shares. And this 960 million shares is 40% of 46,144. So if we say 46,144, 46,144 into 40% gives you 18457. Gives you 18457. Resultingly, what is going to be the difference? The difference is going to be minus 6120. So what is going to happen is their value has increased by 12,337. So we need to establish that if the value of the shareholding has increased by 12,337, so how much have you paid out? How much have they paid against this? So it's 12,337. So the increase in value is 12,337. Loan note which is cancelled is 4,800 million. Furthermore, the cash that they have paid is actually what? The cash they have paid is, how much is that? Is 400 million the cash that they paid. So resultingly, if you see, the venture capital organization would have actually ended up getting 7137 or 7138 extra value shares. They've ended up getting 7138 extra value shares. Okay, so the questions requirement was to discuss the impact of restructuring program on Chrysos and on the venture capital organization. The venture capital organization would be very happy. Why? Because they have got a humongous amount of value for their money that they have paid. Their shareholding has increased and the worth of their investment has actually increased a lot, and they have only had to pay a very small amount. The existing shareholders of the Chrysos company would not be very happy because their shareholding would have diluted. But then again, overall the value that they have might actually have increased. So resultingly, this whole is having a favorable impact on Chrysos company in total. Okay, is it clear now? So what you need to do, you need to evaluate that what has happened, the shareholding, the control, the valuation, the investments, the security, all these actually things are important. Okay, so what we are going to do now is that we're now going to have